Hello and welcome to Dukascopy TV. I'm Andrew Saks-McLeod, CEO of Finance Feeds. And today I'm joined in the studio here in Geneva, Switzerland by Marc Spaelti. Hi Marc.
Hello.
Marc is Chief Operating Officer of Dukascopy Bank, and by Richard McLeod, who is a retired banking executive with 42 years of experience. Nice to see you both.
Hello, Andrew.
Hi. So today we're going to talk about something which is rarely discussed because we're so caught up in our world of high technology in the electronic trading industry that we work in these days. But how did we get where we are? The traditional banking system was not international, very, in some ways, old-fashioned, and was very high touch. Customers would come in and there was no multi-asset. It was purely a banking model. Ethics changed from being a very trust-based model to sales-based model in the 90s, but still very low-tech. Now we've gone almost full circle, but with a high-tech feel where we sell a multi-asset system to customers worldwide. So how did we get where we are?
Well, that's very interesting, Andrew. If you go back 50, 60 years ago, half a century, banking, particularly in the United Kingdom, was relatively old-fashioned considerably old-fashioned by today's standards, but at the time was considered to be fairly leading edge. For example, the accounting system...
It was a mechanical system.
It was a mechanical system, yes. They had accounting machines to process the work. And there was a lot of paper in the work of the day to represent the transactions. These accounting systems had trays of ledgers,
paper.
boxes, paper,
Can you imagine
huge
that?
paper boxes, dozens of them in a machine room, which was operated by a number of staff, depending on the size of the branch. There could be half a dozen or a dozen members of staff with a leader controlling it all and having to process each ledger. And they were in alphabetical order.
Right.
They had numbers as well. But all that paperwork was processed. For example, the clearing system for cheques were cleared in a central clearing house in London and distributed around the branches. And they arrived by post and they were processed. Right. There were transactions over the counter, which were also processed. And the whole thing had to balance with a double entry accounting system.
Imagine that. With now, people complain if the latency on an electronic transaction is 60 nanoseconds.
It's a few milliseconds, absolutely.
Yes.
I mean, obviously we've gone a very big step. I think what Richard wants to say really is, historically, banking was done on paper. You needed it in black and white. You needed some kind of ticket or proof that of every entry that was done.
Tangible,
really? Exactly. In fact, foreign exchange was not very, very different. In the 70s, 80s, we used to still write manual tickets with carbon copies that were distributed to the different offices, and or we had to stamp our tickets. Now, ultimately, having all this paper, having so many people handling the paper, carried a very high cost with it.
Exactly.
And very slow.
And it was very slow, of course, obviously, as well. So ultimately, there was a demand from a client to get more efficient, be faster, do the same thing at a smaller cost.
Yes. But volumes were increasing, you see, and as the volumes increased, there was more and more paper. Right. And the banking industry was becoming overwhelmed by paper.
No backup server. The backup was paper. Backup was paper. Right?
Absolutely, and that was archived. You know, they were kept for at least 6 years, right. And so some of the ledgers 20 years.
When you think about that, you could only have a localized model. You couldn't have an international client base easily, not unless because it's all physical. So nowadays, I don't think, when you think about high quality companies, such as the Swiss Forex companies here, there's 3 or 4 Swiss companies here, some of the very, very good quality liquidity providers and companies in London that do non-bank electronic trading. And then you have the order flow handled by the main banks. Now, when you have that old-fashioned technology like that, and it was important to have a very high relationship with the customer, because you couldn't invest all that in all those resources and then have to try and get new customers all the time, which is a problem we're faced with today, a very serious problem we're faced with today in this industry. Ethics was important because you had to keep that. It was like an institution, even if it was a retail customer. The 1990s came along, banks couldn't make money out of traditional banking. they started selling non-bank products, but non-electronically to local existing customers, and effectively, in a way, metaphorically grabbing them around the neck and making them buy things, which went wrong in the end. Now you can't do that anymore, but the non-bank system has seemed to refine itself. Here we are, we have Dukascopy, Saks-McLeod, IG, Swissquote here in Switzerland, very high technology, very reputable, trustworthy companies selling providing non-bank electronic trading systems. However, the banks doing the interbank order flow, well, we saw what happened to them last year. They all got caught for manipulating the rates and effectively cheating their customers by electronic means. So which is the more ethical and more, what kind of, if you have a customer that's not very astute and wants to, but is high net worth, wants to invest, which model is the most ethical, the traditional manual method or today's modern electronic method?
Well, I would say the traditional one was always had a strong element of ethics to it, because the bank knew their customer and the customer knew and trusted their bank. They knew them personally, and they had a personal relationship, whether they were personal accounts or whether they're small or medium-sized businesses. Yes. The bigger business was dealt with at board level.
Right. So how can a technology-led company emulate that and make a lot more customers worldwide?
I mean, obviously we cannot emulate the personal relationship, especially when it comes to retail FX trading with accounts that average 5,000.
That's for sure.
You can hardly pay a dinner with what you may gain out of a client.
Especially here in Geneva.
Especially here in Geneva, yeah. Now, to come back to the question of ethics, and you mentioned the fixing of rates. Obviously, what happened is, well, with traditional banks, when the spreads were a lot larger, it was much easier to actually get your commission or your profit out of a trade from a client doing a few trades.
Because you could mark it up manually.
Exactly. Now, the spreads have decreased to such a level that, in fact, even a few tenths of pips or a few pips change in price is already seen as a manipulation.
Yes.
And of course, yes, as soon as trading amounts are very big, that may actually be taken as price manipulation. At the same time, I'm not so sure it's all that unethical compared to how it used to be when spreads were just so large.
Because I guess there was no way, because there was no technology. This is very interesting, because back then in those days, if you go back 40 years ago or so, there was no way of the customer checking because it was all written.
You were basically making the price that you wanted to the client, and if he didn't like it, he wouldn't trade, and if he liked it, he traded.
And he couldn't check. There was no way of checking.
He was very difficult to check, obviously.
Yes.
Nowadays, with internet and seeing the competition price, you have an immediate way of checking that price. But again, the client still has a choice to change his bank or his provider if he's unhappy with the price.
Yeah, indeed. I absolutely agree. Very interesting indeed. We'll certainly further on to that in the next episode, but very interesting dichotomy between the classic and the modern, shall we say. Thank you very much for joining me, Richard McLeod, banking executive of 42 years experience, and Marc Spaelti, Chief Operating Officer of Dukascopy Bank. Thank you.
Thank you.
Thank you.
I'm Andrew Saks-McLeod, Chief Executive Officer of Finance Feeds.